Hi everyone, welcome to this week's Squawk. I'm Pav, lead market analyst here at Swyftx, and this week we're going to continue on from a theme that we've been following for quite some time. Just to throw back to an article that I wrote at the start of May for readers and listeners, we spoke about a particular price level that was of significant importance to the US ETF holders. We were talking about 82k US, and the reason why was that when we look at on-chain data and the inflows and outflows of Bitcoin, the net cost basis was about that 82k level. And we did breach into that level where we've now seen Bitcoin specifically and the broader market itself lose momentum that we have seen in the last couple of weeks. Now, we don't know if this trend since the bottom in February is going to continue higher or lower from here. But what I wanted to cover for everyone today is that obviously for the market to go higher, we need more buyers than sellers. That's just a simple fact, right? So we have to understand from a market perspective or a lens, is there still enough incentive out there for the market to keep doing what it was doing? From a macro perspective, if we talk about the broad and open term risk, how has things in a macroeconomic lens shifted or changed, if at all? And then how does that relate back to what we're seeing onshore in the crypto space itself? Within our own ecosystem, what's the dispersion of risk look like? But I'm hoping that I can walk everyone through it today, give you all something hopefully new as a way to look at the markets and insightful on what could come next and how to potentially look to understand it. But what we're going to talk about when we're talking about that macro lens that I spoke about earlier, we're going to dive into what's known as private credit spreads. Now, very simply, if you want to earn a yield on cash, there's lots of ways to do it, right? Two broad stroke ways on which you can do it is through government bonds, which is like your government yields through government treasuries. That's like putting money in the bank account usually. They're usually earning you a short-term interest rate on that money through government bonds. Or you can take your money to the private sector. Now, what's different between the two, there's a lot that's different, but the main thing is the counterparty. One counterparty is the government, and one counterparty is company X, Y, or Z. So the difference between these private credit markets is essentially the grading of the risk. So you have like rating agencies that they rank them anywhere from AAA to, you can see this goes down to triple D and single D. And what they're basically describing is from a counterparty perspective and the type of way that the money is going to be used, what's the risk of that counterparty that you're giving your money to defaulting or not being able to return it to you? So obviously the more risk you're willing to take on, the further you go down, the more speculative you get. Those yields tend to be higher versus the institutional grade ones, which you can see at the top, which are AAA rated with a minimal credit risk. Now, why is this all important? You've got to stop and ask yourselves in the sense of the market moves outside of crypto, obviously, right? So even in this particular vertical, we can see very simply, the same way we think about the crypto market moving between Bitcoin and altcoins, there is a perceived difference in risk profile between those assets, right? Same thing we can say about these credit markets, right? We can see there's a perceived difference to be in a AAA versus something like a double B. And that's what this chart here basically looks to break down. It's showing the periods where the difference between being in a double B, so the incentive to be in a higher risk product, has been much higher in the past versus when it's been relatively the same. And this sort of trend basically describes the market's comfort level in taking risk in private credit markets. Now, again, this doesn't one-to-one move the crypto markets. It's not saying this is, if this moves up or down, crypto is going to do this or that. It's again describing what's the breeze in the air like when we look at this particular segment of the market where there's trillions of dollars moving around, right? And we can tie it back to our market as well, which we won't do today, but you can go look at this yourself. Whenever we do see these massive spikes or de-riskings between these private credit bonds, it essentially does correlate quite well with when we do see volatile events as well in crypto. So it's all somewhat interlinked in the economy. Now, what I want to show you today is essentially what's been happening in this chart. So again, we're talking about double Bs minus triple As in the US. So we're talking about what incentive is there for the market to take some of these higher risk yields versus the very safe ones, which is your triple. I wouldn't say very safe, but in comparison, they're safer, less counterparty risk. It has been tightening, right? So we did see these absolutely blow out in 2020. Again, in 2022, had the inflation crisis there. And along the way, we've just continued to see the spreads here essentially narrow. So what that basically means is that the market's become more comfortable being in a double B as much as it has been a triple A. Not one-to-one. They're not paying the same rate. But essentially, when these spreads are coming down, you're not getting that much extra yield for going into what's basically being graded by these agencies a higher risk product. We can see that when we have seen volatile events in the past, however, like the trade war here in 2025, and most recently some of the geopolitical tensions and the oil crisis and all that jazz, we have seen these spreads blow out. But each time we have seen it retract and return lower. So again, we don't know what's going to happen with this moving forward. It's obviously something we want to be quite potentially aware of when we're thinking about the macro lens on everything right now. But what we do know is we're essentially at multi-year lows. So what we're seeing with this chart is essentially, as we've seen time play out, the markets continued to become comfortable taking on those higher levels of risk, even at the point where we've now seen those spreads come under a 1% difference between each other, right? For example, if a AAA bond is paying 6%, this might be paying 7%, and people are quite happy to take that on board right now. So essentially what we want to look here is, I'll tie back to it later, essentially is if we do see this continue to go sideways or continue to grind lower like we have, we're getting close to zero, being at 0.86 right now, the market is again just continually okay to remain risk on, perceivably, right? We don't know if one of these volatile events is going to happen anytime soon, if or when it's going to happen, but that is essentially what we'd look for, is to understand is when is a de-risking taking place, right? And why that matters is if we look back again here at the 2026 period recently, we did see these spreads increase to the upside. We did see it go over that 1% threshold, then fall back down. That coincided again with a period, like I mentioned, where it's not going to be a one-to-one correlation, but when those credit spreads are starting to widen, and it also results in volatility in our markets as well. So I've basically broken down the segment of how I would put a spectrum around how I'd look to put a legend and measure risk in the crypto markets through the lens of stablecoins, which I've used USDT plus USDC, others, which is the trading view ticker for altcoins, so anything outside the top 10, and then Bitcoin, right? So the blue chip. So essentially we can see the market's preference. So this is measuring the market dominance. The market's preference, when we did see that credit spread blowout occur, really shifted to stablecoins, right? We did see at the perceived risk in market, broadly speaking, we did see a heightened concern. We did see degrossing on a gross basis. And even in the crypto space, we did see a preference for the market to move into stablecoins. Now, what's also interesting is that if we look at the performance of Bitcoin, this market dominance since the start of this year, it's remained relatively flat, a little bit of an ebb and flow. And we did see that February to March to April, we did see it recover now where it's floating about that 2% level. But altcoins have interestingly been a lot more volatile. We had seen at the start of this year, altcoins greatly outperform Bitcoin. And also once we did see that movement into February, it also outperformed it quite well as well. But then as we have seen the market correct, we've seen it now slow down. So most recently at the start of May, when we have again seen altcoins vastly outperform Bitcoin. Now where this sort of leads to is essentially if we're looking about the market, looking ahead, we're trying to understand how's the broader risk appetite looking. Right now it looks steady, right? And again, it's steady until it's not steady is what I also caution as well. But again, if we're looking at this and we're seeing this continue to run sideways, and we continue to see maybe this trend of USD stablecoin dominance continue to curl over, it does set up that playing field for, or narrative, if you could say, or that scenario that you'd want to be watching for, that maybe altcoins continue to outperform Bitcoin, number one, which it has recently. And again, maybe even start to eat away at even more share of that US dollar stablecoin supply. Now, again, the opposite is true as well. If we do see some reason for de-risking in the broader market, and that does also spill over into crypto, which it can do, then this would also look like stablecoin dominance rising and likely the altcoin dominance falling like we have seen in the past as well. So I hope that's been insightful. A different way to think about things, looking at the market through the lens of a way to measure risk. This isn't the only way. There's lots of other different ways to do it too. But this does give a sort of a if this, then that scenario to work off of if you're trying to understand what happens from here out from the market. But that's it from me here at Swyftx. Catch you next week.